Welcome back, everybody, to another episode of Multifamily Investing 101. I'm your host, Travis Watts, the Director of Investor Development here at Ashcroft Capital. Going to share my screen with you right now and discuss today's topic, which is vetting syndications. We're going to talk about the market, the deal, and the operator, which are three primary categories that you're going to want to get good at vetting as a limited partner investor. Now, disclaimers as always, this is for educational and informational purposes only, not financial advice, not legal advice, not tax advice. Please seek licensed financial advice when it comes to your own investing. Now, for those that may not be familiar with a syndication or a real estate private placement, this is basically how it works. That is you front and center at the top. You are a limited partner or a hands-off investor, if you want to look at it that way. You're investing your own capital into multifamily properties in the commercial space, at which point a general partner, in this case Ashcroft Capital, is the group that found that property, put it under contract. They're going to act as basically an asset manager, taking care of the day-to-day operations in conjunction with the property management group and trying to grow the rents and revenue on the property, execute the business plan, maybe do value add, improving the units, making them nicer, newer, and safer for residents, and ultimately selling several years down the road. Now, distributions come in the form of passive income to investors who are investing in this private real estate syndication. Now, I want to talk about the market, what good markets look like and what to look for when it comes to the market as an investor. And the first thing I'll start with is a very macro level lens. This data is from Zillow, and this is the share of renters by region across the United States. So as you can see, the majority of people renting in 2024 are in the South or the Sun Belt states, which happens to be where we operate. That's not the exclusive reason as to why we invest in the South, but that is a big reason that there's the highest demand in those areas. Now, this was published by Berkadia, and what this is showing you is a map of the United States and the demographic migration trends. In other words, this is a forecast from 2024 till 2030, what markets are set to grow at the most rapid pace. So as you see the little legend there, the green is high growth and the red is very little growth or people leaving the area. And to the right of your screen are the top 20 metropolitan areas. Again, it's only a forecast. The data is from Berkadia, but we operate in a lot of those top 20 MSAs. So this information is accessible to everyone. You can simply run a web search. There's lots of national sources that give this type of data out. So you can kind of use it as a bit of a cheat sheet to see where people are going. Because at the end of the day, when it comes to residential multifamily apartments, it's all about where people are at, where people are moving to, and where jobs are located. So this data can be invaluable to you. Now, I'll talk a little bit about our AAA process, which is an acronym that stands for the Ashcroft Advantage Analyzer. It's a proprietary process that's unique to us as a company, and no less than 2 times per year, we are looking at tons and tons of data that gets pulled from CoStar and RealPage and Green Street and the US Census, among so many other sources. We're compiling that data to figure out where we want to buy the next property and to ensure that the properties we currently own are still in strong markets. Now, I'm not going to read all this list to you, but I'll show you as kind of a macro level overview. These are a lot of the areas that we research and look into. Things like economic indicators, demographics, housing market metrics, infrastructure and development, what the regulatory environment looks like in a particular market, market sentiment, investment activity, risk factors, rental market dynamics. Then there's all the subcategories underneath. Now, one thing I'd say here is this is one of the biggest benefits to being a limited partner investor with top operators and syndicators in the spaces. They're doing this data analyzing for you so that you don't have to. Now, you can certainly dig into all of this yourself, create your own AAA process, so to speak. It just does require a lot of time, effort, and energy to do it. So we do it on your behalf. Now, in today's market, staying on the topic of market, just to kind of conclude here, this section, this is kind of where we're at in the market cycle as far as commercial real estate is concerned. This is not the broader economy. This is commercial real estate specifically. We're in phase 4 of a market cycle, which is defined as a recession. Now, the recession was caused by the Federal Reserve raising interest rates at one of the most aggressive and quickest timeframes we've seen in U.S. history. So how do we know that we're in recession, or how can we back this up with data? Well, what defines recession in commercial real estate is increasing vacancy and more completions of new apartment units coming to market. So if we pull CoStar data as one example of many, you can see Q1 of 2024, what's happened? Well, the orange line is vacancies, which have risen or increased. That means more units are vacant on existing multifamily properties. And new supply is the blue line. You can see how much new supply has been hitting the market for the last year and a half or so. Now, as we move forward, again, this is a forecast published by CoStar, but as we look forward on the green bars, that is the absorption. How many people are being absorbed into this new inventory? You can see that it starts to quickly outpace the amount of new supply coming to market. So what does that mean? It means in the very short run, over the next year, year and a half, we're going to have an abundance of supply and not enough people out there to fill them up. But then soon after, you're going to have more people wanting places to rent and not enough units available. So in recent news, this was published by the Wall Street Journal, Blackstone made a $10 billion multifamily purchase going on the real estate offensive. As we've been in this recession market cycle for a couple of years due to interest rates, that's been essentially a huge bullish flag for the entire industry, quite possibly signaling now is close to or at the bottom of the cycle, and the big money, so to speak, is coming back into the space. Also, interest rates at this point are anticipated to come down in the following years. Now, no one knows when the first rate cut's going to start, how much it's going to be, how aggressive the Fed is going to get, but bottom line is rates are expected to come down. They've held these rates at 5 to 5.25 Fed funds level for about a year now. And so now the next move, as inflation has meaningfully come down and as economic data supports it, the Fed is looking to reduce rates. Now, once again, inflation peaked out in 2022, has already come down in a very significant, meaningful way, and is anticipated to continue falling into 2025, where hopefully it stabilizes and stays moderately low, which is what the Fed is looking to see. Now, this chart is very important to consider because, as we just talked a little bit about supply and demand, the data I showed you from CoStar, these are multifamily building permits. Okay, these are developers, and whether or not they are pulling new permits to build new product as we move forward in 2024 and beyond. Now, this is showing you from the peak of construction through today how much these permits have fallen and reduced. In other words, builders are pulling out of the market because of the high interest rates and for other reasons. Many of the markets we operate in here at Ashcroft are shown here on the screen, such as Dallas and Atlanta and Tampa and Orlando, Fort Worth, Jacksonville, and Fort Lauderdale. So a lot of these are down roughly 40% in terms of new product. Meanwhile, the National Multifamily Housing Council suggests that the U.S. needs to build approximately 4.3 million more apartments by 2035 to meet the demand for rental housing. So on one hand, you have this severe shortage of housing. And on the other hand, you have builders deciding not to build as we move forward and demand increases. So where does that put you as an investor years from today, getting into deals right now, back to a supply demand imbalance that would be in your favor? Now, one other metric to consider and think about is the cost of home ownership today compared to the cost of renting. And we're nearing an all-time high gap in US history, meaning it is far more expensive today to go out and get a mortgage and buy a home compared to paying apartment rents. As we move forward, hopefully that equalizes a little bit and comes back into normalcy. But right now, it really makes the case for renting. A lot of people obviously are forced into renting situations, but equally, a lot are choosing to rent out of a simple lifestyle preference. So with all of that, cap rates have risen over the last couple of years because of the higher interest rates. That's a reflection there on the screen of June 1st, 2024. The higher cap rates go, the lower commercial valuations get. So essentially what that line is showing you is hopefully the bottom or the bottoming of the market cycle. And from this point moving forward, the fundamentals begin to strengthen and pricing stability starts to come back into the commercial space. So while it may not be a great thing for pre-existing properties that you currently own from past years, it can be a very bullish thing for new investments that you're making right now as you're essentially buying the dip. So some key takeaways to consider from these slides. Rates have reached a peak and plateaued for nearly a year at this point. Rates are projected to come down over the next few years. Lower rates would entail higher valuations in the commercial real estate space. Multifamily fundamentals remain strong, and commercial real estate is on sale right now due to these higher rates. So with that, now we'll talk about the deal itself. And one primary thing to understand about a deal that you're potentially looking to invest in is how it's valued. And this is the simple formula to follow. You take the net operating income that the property produces and you divide by the local cap rate in the market in which it's located in, which again is free information. Brokers and realtors have this information, but you can simply run a web search to figure out. And cap rates is what I showed on this slide a few slides ago. So if we took, for example, a property today that's trading at a 6% cap rate and has a net operating income of $2 million, and we run the math, you come up with a valuation of about $33,333,000 and some change. But here's the cool part about commercial real estate. If throughout your business plan, let's say over the next 3 to 5 years, you start renovating the property, making it newer, nicer, safer, well, if you could turn that net operating income into $2.5 million over, let's call it a 5-year time frame to be conservative, and cap rates in the meantime have come back down, which again is a positive for valuations, you can see how much potential equity you would have from your starting point, right? 33 million to basically 50 million. So that's the game that we play. That strategy is really not possible in the single family home space because net operating income is really not a factor that derives the value to single family homes, as most are not rentals. And even if yours is a rental, the next buyer may want to buy that house to move into, and they could care less about cap rates and NOI and everything else. This is specific to commercial real estate and how it trades. So basically, we'll go through a practical example here in a minute, and I'll show you how this looks on a value add property. But basically, in recap of what I just shared there, this is also why transaction volume has fallen off a cliff since the peak, is because rates went up and therefore valuations came down. And so a lot of owners and holders of commercial are trying to hold on to what they have and wait for the market conditions to improve from here. So here's an example I want to share with you on how a value add project can work in the multifamily commercial space. If you had starting rent at $1,500 per month, let's say on a large apartment community, but the market rents are $1,700 per month. What that means is you've got $200 of potential additional income per unit that you might be able to grab. So in an example of a 400 unit commercial building and raising the rents $200 a month, again, over a, let's call it a 5-year time frame, then it would effectively give you $960,000 per year in additional income. Of course, not including the expense side of the equation, but this is just a simple example purpose. How much value would be added? Well, if you simply take the same formula as before, you take the income, the new income in this case, and divide by the cap rate, we'll say 5%, then $19.2 million in potential valuation was added. Once again, not including the expense side of it, but the whole name of the game is to raise rents and raise revenues in this space. But how likely is what I just shared with you? $200 a month over 5 years? Well, it's basically $40 per month each year that you hold the property. And that really breaks down to less than a 3% increase year over year. So pretty realistic given the stats and history of what real estate has done, given inflation metrics. That's basically just keeping up with a very mild to modest inflation rate. So now I'm going to move on to the final category and talk a little bit about the operator, or the jockey, so to speak. There's a saying in the industry that you want to bet on the jockey, not the horse, meaning the operator behind the scenes, their ability to actually execute the business plan. So I'll take Ashcroft Capital, obviously, for an example right here, but plug in any operator and any name, and all the stuff still applies. The first thing is to take a look at track record of the operator. What do they specialize in? How many times have they done it? And what is their success rate? In our case, we've taken 26 deals full cycle through the business plan. That means we bought it, we improved it, and then we sold it for a profit. Now, that's resulted in a 25.6% annualized cash on cash return to investors, or a 22.7% net IRR return to our limited partners. Now, another thing you want to look for is testimonials. Now, you can look for them organically and through conferences and networking events and stuff like that, but they can be tricky to come by. So we made it simple and easy for our prospective investors. And we basically have showcased over 100 video testimonials of our actual investors. You can visit ashcroftinvestors.com. And you can also sort by profession if you want to see others that maybe work in your profession who invest with us, or you can search by geographic region if you want to find some of our investors that may be local to your area. Again, ashcroftinvestors.com. Very important to, in my opinion anyway, to hear what others have to say about investing with a group. Now, vertical integration means, in a general sense, that not only is the operator finding the deals, underwriting the deals, executing the business plan, but they're also managing their own properties. And for us, we own a company called Birchstone Residential. It's our own in-house property management company with one client, and that is Ashcroft Capital. So we're not in the business of managing other people's properties. We're solely focused on managing our own portfolio. In addition to, we own Birchstone Construction, which is our own construction firm. We don't do new construction, not to confuse anybody, new development and stuff like that. I'm talking about renovating the units on site. So everything's under one roof, which is, boots on the ground in all of our regional areas, a huge cost savings, tremendous efficiencies built into that business model, and much more transparency. And those savings just flow through to you as an investor. So vertical integration is definitely something to consider when it comes to vetting different operators. The last thing I'll point out is just portfolio in general. It kind of goes in alignment with track record that we talked about a couple minutes ago, but what is the portfolio of this group? And again, we've made it very easy for prospective investors. You can visit ashcroftcapital.com, click on portfolio in the upper right, see our current assets that we hold now, and see all the past assets that we have bought and sold. You can hyperlink each of the photos. It goes directly to the property website to get a better feel for our renovation scope and quality of assets that we have.
We're excited to partner with you on this deal, and we invite you to learn more. You can visit investbraxton.com.
Thank you so much for being here. You're listening to Multifamily Investing 101. I know this has been a longer-winded episode, longer than most on this series, but I felt it was very important to cover the vetting process as a limited partner. So hopefully find some value in that. Don't forget to like, share, and subscribe, and we will see you on the next episode. Thanks for watching.